The only MACD technical analysis video you will ever need. Today, I will show you why the MACD is one of the best scalping and swing trading indicators for all traders. This video provides a clear, winning, step-by-step guide to how to use the MACD indicator correctly in the forex market, stocks market, or any financial markets, and generate consistent profits. So, by the time you finish this video, you'll know exactly when to enter high probability trade using the MACD indicator. As usual, we'll have plenty of practical examples. The idea is to fully understand this wonderful trading strategy and to make the most out of it. If you want more videos more often, please smash the like button, subscribe, and turn on the notifications bell so that you know exactly when new content is released. A very important point before we start. Everything we discuss in this video can be used for currency trading, stock trading, and crypto because price action stays relatively consistent across different assets, so we're going to go very in-depth in this video. The MACD indicator is a popular momentum and trend following indicator that is based on the information of moving averages and, thus, ideal to act as an additional momentum tool and momentum filter for your trading. In this video, we will explain what the MACD indicator does, how it helps you analyze price, and how to use it in your own trading. First, let's take a look at the individual components of the MACD indicator. MACD line. The MACD line is the heart of the indicator, and by default it's the difference between the 12-period EMA and the 26-period EMA. This means that the MACD line is basically a complete moving average crossover system by itself. Signal line. The signal line is the 9-period EMA of MACD line. MACD histogram. MACD line minus signal line. In this video, we focus on the MACD and the signal line in particular. The histogram is derived from the other two components of the MACD and, thus, don't add as much explanatory value to overall MACD trading. The basics of the MACD indicator. As I said, the MACD is based on moving averages, and this means that it's ideal for analyzing momentum, finding trend following entries and staying in trends until momentum is dying off. There are two MACD signals in particular that we will explore in this video and explain step by step how to use the MACD to find high probability trades. First, the MACD line cross zero. The simplest strategy you can think of with MACD is trading when the MACD line crosses the zero line. Because MACD is the distance between two moving averages, this trading strategy is exactly the same as trading crossovers of two moving averages. There is zero difference. In this example, besides the MACD lines, I also plotted the two moving averages on the charts, and it becomes obvious immediately how the MACD works. When the two moving averages cross, the MACD line crosses below zero as well. As I said above, the MACD is thus its own moving average crossover system in just one line. As we know from our moving averages videos, a cross of two moving averages shows a change in momentum, and it can often foreshadow the creation of a new trend. So, whenever the MACD line crosses zero, it shows that momentum is changing, and potentially a new trend is just being created. MACD line above zero line. The MACD crossing above the zero line, from below, is often considered a bullish signal. In most cases, it indicates the upward momentum is building up, and that price of the underlying security is likely to increase significantly. The higher the MACD line is from the zero, the stronger the signal and the likelihood of price moving significantly higher. In this case, traders will look to enter long positions in anticipation of price appreciation. Likewise, whenever the MACD line crosses the zero line below, from above, it is interpreted as a bearish signal, signaling that the price is likely to fall. The further away the MACD line is from the zero line in this case, the stronger the bearish signal. Second, the signal line. When you see the two MACD indicator lines move away from each other, it means that momentum is increasing and the trend is getting stronger. When the two lines are coming closer to each other, it shows that price is losing strength. Trading tips. First, as long as the MACD lines are above zero and price is above the 12 and 26 EMAs, it's commonly interpreted as a bullish trend is still going on. Second, as long as the MACD lines are below 0 and price is below the 12 and 26 EMAs, it's commonly interpreted as a bearish trend is still going on. Third, when the MACD lines are crossing above or below 0 and the two MACD indicator lines move away from each other, this is high probability MACD trading signal. Here are other examples of how to trade the MACD line cross 0 to fully understand this wonderful strategy and to make the most out of it. This should be simple enough. Or, in this video, I've included a template with the system that you can simply upload to your chart, and it will automatically plot all these indicators perfectly on your charts, so there's nothing for you to worry about. Get the download link on the description. Trend following entry. During ranges, the two lines from your MACD are very close together and they hover around 0. This means that there is no momentum and no strength. At point 1, the price also formed a narrow range, and when the price breaks out, the two indicator lines pull away from the 0 line and also separate each other. Then, during a trend, the moving averages can act as support and resistance and stay you in trends, as the phase 2 and 4 show the price never broke the moving averages. During a consolidation like in point 3, the MACD contracts sharply as well, and traders wait for the breakout of the wedge to signal a new trend. The divergence at 5 is a signal we will explore, and it predicted the reversal. During the downtrend 6, the price then again stayed below the moving averages, while the MACD lines stay below 0. Here are other examples of the MACD trend following entry to fully understand this wonderful strategy and to make the most out of it. MACD divergences as early entries. MACD divergences are another great way to analyze price and find early trend following trades. You can see in this example how the price was moving higher very slowly over a long period of time. At the same time, the MACD moved lower, showing that there was no buying strength behind the slow grind. Then, suddenly, price broke below the two moving averages with stronger which happened, while the MACD lines crossed below zero and also separated further. This can be the signal of a new strong downtrend. The MACD divergence is a situation where the price creates higher tops and the MACD creates a row of lower tops, or the price creates a lower bottom and the MACD creates higher bottoms. MACD divergence after a significant uptrend indicates that the buyers are losing power, and MACD divergence after downtrend indicates the sellers losing power. The most reliable way to use the MACD divergence is to combine it with price action. In this video, you'll learn to implement the MACD divergence indicator, one of the most powerful trading strategies to use. Here are some examples for using the MACD divergence. This is called the 2 divergence. In this case, when we focus on the price, came after a very clear MACD divergence between the MACD and the price itself. After a significant and long uptrend, the price is beginning to lose power, the candles are very small and tight, and the price is struggling to move up. After this uptrend there is a high before the last high, and the last high is higher than the previous one, like we usually see in uptrends. At the same time, we can see clearly how the MACD divergence creates a lower high. This is the divergence between the price and the indicator. The price creates a higher high. The line goes up. And the indicator creates a lower high. The line goes down. This is called a 2 divergence. That's what usually happens after a divergence, a reversal. The momentum switches from bullish to bearish, or we get a technical correction. This is called the 3rd divergence. This pattern looks for a very rare but powerful situation, which is a 3 divergence in RAW between MACD and the price action. It usually identifies significant technical correction or even reversal opportunities. In this case, we have a 3rd divergence. There are 3 highs, each one higher than the previous one. While the MACD indicator has 3 highs, each one lower than the previous one. When we see 3 divergences between the price and the MACD, it's a bit more reliable than 2 divergences. This should be simple enough. Or, in this video, I've included a template with the system that you can simply upload to your chart, and it will automatically plot all these indicators perfectly on your charts, so there's nothing for you to worry about. Get the download link on the description. As always, if you learned something new, or if you want more videos more often, make sure you subscribe, click the notification bell and leave us a like to show your support. See you next time.